Hey gang, welcome to Time in the Market, the investing channel with a long-term focus, taking a quick look at Shopify. And oh my God, these guys were down 10% after their earnings call the other day. The world is over. Oh wait, they were up about 5% today, so I think they're recovering. It's really important when you see an earnings call and when you see a really big reaction to that call, and 10% in the grand scheme of things these days isn't that big, to zoom out and kind of think about what has the stock done in the last year, in the last 5 years, et cetera, because growth stocks can be really erratic on the way up and on the way down. And if you zoom out here, the stock is still up about 51% in the last year. It's been a really, really good performer, and that's been the case with a lot of growth stocks. My question, as someone who invests in a lot of growth stocks and has benefited from this upward move, is are things getting pricey? And I wanted to look at Shopify because this is a company that I owned in the past. I owned this in 2019. I sold this somewhere in 2021, made a really good return on it. You zoom out, kind of see what happened after that. The stock kept rising even more after I sold it. And it's very easy to feel like a fool when you take some profits on a stock. But then valuations do end up mattering in the long run. When the market dynamics shift, people start thinking about valuations a bit more. Maybe interest rates start to go up. Maybe interest rates get locked in for an extended period of time and remain that way for an extended period of time, more so than the market thought. Stocks could really move in the opposite direction really quickly. So this stock went up all the way to 170, fell all the way down to 30 bucks, and started rising again into the 70s, fell all the way into the 40s, started rising again, and is now sitting in the 80s. I kind of wish I didn't lose track of the stock because I love this company. I love what they do. If you're not familiar with Shopify, they are an e-commerce platform. They essentially offer business in two reporting segments that they have. There's their subscription solutions business, which allows people and businesses to essentially set up an e-commerce website easily, quickly, and rather cheaply. They have plans that are anywhere from $39 per month all the way to $2,500 per month. Plus, if you're an individual who wants to open a small store, you'd be in that $39 per month bucket. If you're a larger business, and they've been working with a lot of businesses that have, tens of millions of dollars in annual revenue going through their store, that's probably in that $2,500 plus range, and that allows you more customized options. You can do your own coding on that website, etc. Whereas on that $39 per month plan, you're probably just doing, really basic stuff. And they have themes, and they have other stuff that you can purchase. And then they have a merchant solutions business, which after you set up that website, what kind of services do you want? What kind of buy-ups do you want to have? They have a payments processing platform. They work with Stripe rather, and Braintree to kind of do the processing, but they also take a cut of all payments going through that platform. They also allow you to choose PayPal or other payment processors if you want, but obviously the benefit is there for Shopify if you use Shopify Pay. And I really like Shopify Pay and what they offer. If you really ever used a Shopify based website and you have Shopify Pay as an option, give it a try. It's really simple. Once it has all of your information, it's really quick to use it again on another Shopify platform. They also have a point of service system, point of sale system, I suppose is what they call them. Kind of similar to those Stripe, swipe your card when you check out at a retail store. So maybe if a brand has a Shopify based web store, they want to add those to their store as well to kind of combine their in-person retail experience with their e-commerce retail experience, keep all of the data together. They have a shop app where you can buy a bunch of stuff, and cash rewards exist on that app as well. They have a buy now, pay later service. They partner with a firm in order to do that. A firm gave them actual shares in a firm themselves, so they own about 14% of the voting rights of a firm and about 4% of the overall public shares of a firm, at least as of 2022. So that's a pretty cool thing that kind of shows the pricing power of Shopify these days. Shopify itself, Shopify websites are about 10% of all e-commerce being done in the United States is done on a Shopify-based website. That number is about 6% in Western Europe, and it's growing internationally as well. So a lot of stuff that they offer, and it's a really, really cool offering that's been growing at a good clip, and that revenue has grown at a good clip as well. So as we look at their Q4 earnings and their full year earnings, results aren't actually that bad. Revenue for the full year was up 26%, deaccelerated a bit in four, down to 24%, but still growing at a pretty good clip. 58% of the gross merchandise volume is going through that Shopify Pay um, processing. And again, Shopify is taking 1 to 3% of the um, item cost whenever that is used. So that's a pretty good thing for them. This is a good margin business. Gross margin is about 50%. Free cash flow margin is about 13%. So finally turning free cash flow positive in 2023, up from negative free cash flow of 186 million the prior year. So that's really, really solid. One thing to note is that even though it's 905 million, about 600 million of that is stock-based compensation, non-cash expense, but it is dilutive to shareholders. So why was the stock down? Well, outlook was pretty good, but I think there were some concerns about gross margin being a bit lower than expected, free cash flow guidance being a bit lower than expected. I think most estimates were calling for low teens versus high single digits margins on the free cash flow side. A lot of that is driven by higher expenses, both employee costs and marketing expenses. And I think the expectations for full year 2024 free cash flow margins were closer to 15%, but they were kind of pushed down closer to 14% after this call. So that's certainly going to impact your pricing of the stock. But I think really it's also important to note that this is a stock where growth is starting to slow a little bit. Yes, it's 26% for 23, which was actually up from 22, but it's going to slow down in 24, at least expected to slow down in 24, expected to slow down again in 5, but still continuing to grow in the high teens, well into the late 20s here, and margins expected to improve to the high teens as well, 728. Maybe some of these are optimistic, but at the end of the day, this is a company that's growing at a pretty good clip, continuing to go at a pretty good clip, has a good balance sheet, no real debt to deal with. They used to have a fulfillment and logistics business. They actually got into that kind of in a big way in 2011 with a $2 billion acquisition. And then by 2023, they were selling that and kind of partnering with the people they were selling that business to help their customers with their fulfillment and logistics concerns. So really an all-encompassing service that they offer. If you want to set up an e-commerce website, Shopify can do that for you. Certainly a lot of competitors out there. You're talking companies like Wix, WooCommerce, BigCommerce, WordPress, etc. Some cheaper, some better in certain areas, some worse in certain areas. But Shopify has done a really good job of integrating all of the services into one place. They've done a good job of expanding Shopify Pay, not only into websites that are run by Shopify, but also into social networks. Like the family of apps can easily be integrated with Shopify Pay. TikTok can easily be integrated with Shopify Pay if you want to sell stuff on TikTok. If you want to sell stuff on YouTube, you can easily integrate it with the Shopify Pay if you have a Shopify store. All of that stuff has led to really good results on the top and bottom line. I think the stock market has rewarded that. Now the question is the valuation still a bit too rich, or is this a stock that I would want to get into? First, a disclaimer: video is purely for informational, educational, and entertainment purposes only. It is not investment advice. Please do your own due diligence. If you ever want to play around with this spreadsheet yourself, as I look at it, hit file, make a copy. You can change whatever you want on here. So as a reminder, this is a $100 billion company. So a $100 billion company that generates about $1 billion in free cash flow, most of which is stock-based compensation driven. So that's a sub 1% free cash flow yield. Now, because this is growing so quickly, maybe that's accurate, but still very richly valued at the moment, especially if growth is slowing. As far as dilution goes, this has been a dilutive company. They haven't been buying back shares. They've been issuing shares to either make those acquisitions or as part of stock-based compensation. Done really well in the last year, probably not so well if you were a buyer during the pandemic, during those all-time highs. But at the end of the day, markets rewarded this with a pretty rich multiple. The question is whether or not that makes sense, whether or not this growth can continue. So as I look at the revenue growth here, I kind of am in line with what the estimates are showing, about 20% growth in the next year, kind of slowing down into high teens revenue growth by the end of 2028. And the assumption is that that kind of continues at that level for at least a little bit of time probably another 5 years or so in order to make sense of the multiple I'm going to give it. Free cash flow margins expanding kind of into the higher teens, kind of stopping at a 17.5. I think they probably have some expansion room from there. I've seen estimates as high as 19% for this company, but I want to be a bit conservative here. And as far as buyback goes, because of the amount of stock-based compensation they have, I'm issuing a negative buyback here to kind of account for that. I don't want to just assume really good free cash flow that's driven by stock-based compensation, not reduce the returns due to a negative buyback yield. Now, obviously, in the next couple of years or so, they can institute a stock buyback to reduce that because they are going to produce about $10 billion in free cash flow in the next 5 years if these estimates prove out to be correct. So they have to do something with that money, and a stock buyback is a possible situation to that. But at least, even if they do that, at the very least, they should do something to cut back on the stock-based compensation and stop diluting shareholders. Really doubt they're going to do a dividend anytime soon. That would be a silly idea. Maybe make some small acquisitions. I don't think they're in the market for anything huge, but certainly something small to help their business grow, to expand into other avenues that might be high margin as well. But at the end of the day, right now, I'm just assuming negative buybacks that you can adjust if you like. So right now, the market is giving this a 1% free cash flow yield. And if I look at this 5 years from now, I think a 1% free cash flow yield is tough to swallow. It's certainly possible. And if that happens, then you're looking at a pretty solid return given the growth potential here. If you think that a 1% free cash flow yield that the market is giving it today is still reasonable by 2028, then you're looking at a 22% annual return. But that is a pretty big if in my mind. For me, I think a more realistic assumption is about a 2% to 3% free cash flow yield. And to be aggressive, I'm going to put an 80% assumption on a 2% free cash flow yield and a 20% assumption on free cash flow yield. So it's closer to 2% by 2028 than 3% in my mind. And that seems reasonable, assuming then the growth is still where it is, that the estimates for 2028 aren't too far off from this. That this is still going to be growing at a mid to high teens clip by the end of 2028 and into 29, and that margins are either kind of mature at that point or even expanding from here, because that's still a pretty aggressive multiple given what we know about the market today. Now, obviously, if interest rates fall to zero and things like happen like that, then maybe a 1% free cash flow yield will make sense. But at the end of the day, that's a big if as well. So I don't want to make, as I put these valuations in there, with these assumptions in place and with these growth assumptions at this $80 price point, I'm only getting about a 4.7% annual return from today. And that's not that impressive. And the reason for that is obvious. Right now, you're essentially getting a free cash flow yield today of 1%, and you're cutting that valuation in half from a valuation perspective by 2028. Now, that's offset in a big way by the growth in free cash flow, because your free cash flow is more than doubling from where it is today, almost tripling. But that still doesn't offset the fact that your valuation is essentially being cut in half. And that's kind of the risky thing with these growth stocks. Whenever you have something that's getting a 1% free cash flow yield, and that's aggressive. You kind of think about a company like Google probably getting a 4% free cash flow yield, a company like Apple probably getting a 3% free cash flow yield. Even NVDA is probably getting like a 2.5-3% free cash flow yield. And maybe those companies aren't growing as fast as Shopify, or expanding their margins are as fast as Shopify, maybe outside of NVIDIA. But is it that crazy to think that a company like Shopify could get cut to a 2% free cash flow yield if the market dynamic changes a little bit? Right now, everything is pointing in the direction of growth. Growth is hot. Growth is amazing. Growth can't stop. But if the market changes their tune a bit, if another inflation report comes in hot, if interest rates seem like they're going to stay high for a longer period of time, is it that crazy to say that this should be valued at a 2% free cash flow yield even now? And that's why this stock dropped as much as it did not too long ago. Like if you think about where the stock was in 2021, probably being priced at like a 1% free cash flow yield as of 2028. And then the market changed its tune, growth slowed down a little bit, and the stock dropped like 75%. And then it rose again, and then it dropped like another 30% pretty quickly. So stocks like this can move really quickly, and it's just because of this. Because if you assume that your free cash flow yield in 2028 is going to be 1%, your annual return is 22%. If things change a little bit, And a stock like this maybe misses its growth potential a little bit, or the margins don't expand as much as you think they would, and suddenly this is valuing the stock at, the market is valuing the stock at 3% or 4%, the returns could be, anywhere from -7 to -2, depending on where you are on that free cash flow yield valuation area. That's kind of why it's tough to value companies. And while I love this company, and I think this company is fantastic, at an $80 price point, the return is so dependent on everything going well for this company that it's hard for me to make sense of it. And I could be wrong here, right? If you're watching this and you are a huge bull in Shopify, you could just say, well, I think growth here is going to be way better than you're projecting. And you may be right. If that's the case and it's still growing at a nice clip, then maybe 1% is accurate. You could say that, hey, maybe free cash flow margin is going to be way better than you're projecting. Maybe they can hit low 20s. And if you put a 22 in, even at these assumptions, you're getting a fair value of basically where it is today. But you have to make those assumptions. You have to be comfortable with those assumptions. I don't think I am at the moment. Like, I don't think I know enough about where the company is right now to assume that their margins in 2028 or in the future are going to be in the low 20s. And if they are, and if they grow faster, and if their margins expand faster, then this could still be a fantastic return from today's price point. But given where it's priced at today, I don't think I'm willing to make that bet personally. Certainly, your choice on what you want to do. As always, this is not investment advice, but for me, if I wanted to buy this stock and I look at the expected return based on these assumptions about 4.7%, and then my target return of about 10%, that'd be a fair value of about $63. And I think these assumptions are relatively aggressive. Like, you may think that a 2% free cash flow yield on this is not that aggressive, but I think it is. Like, I think knowing what I know about the market, even where it is today, like, you could go to NVIDIA, and NVIDIA right now is probably being priced to a free cash flow yield that's higher than 2%. And NVIDIA is a stock that I own. And people are saying that NVIDIA is wildly overpriced. And I don't know if it is, because I think they have a lot of potential ahead of them, and they're going to generate 40 to $50 billion in free cash flow in 2024. And that's pretty impressive growth given where they were just a year ago, and there's potentially more runway ahead of that. And certainly Shopify is showing really good growth, but if these guys are valued at a higher multiple than NVIDIA, are they overpriced or are they just a better company? I'm not sure. Let me see if I'm actually right about NVIDIA. Before I got to turn. Go to NVIDIA, go to valuation. They're at 2.4% next 12-month free cash flow yield. Still pretty good. Pretty good, considering this is at 1%. So is NVIDIA going to grow slower than Shopify? Maybe. Maybe Shopify has more runway ahead of them. And that's potentially true. Like I said, Shopify only has 10% of the e-commerce market. And this is a market that's constantly growing. 10% in the United States, mid-single digits in Western Europe, probably lower in the Asian markets that they might be in. So there's a lot of expansion, and the overall piece of the pie is expanding as well. The number of services they're going to offer is expanding as well. So there's always going to be additional things they can add to make more money from each additional customer. They have pricing power. They just raised their subscription services 33%, and they're not expecting a lot of people to leave. That's pretty good pricing power. And as far as their pricing is concerned, for the amount of services they offer, they probably still have a lot of good runway to go. And as more people start using Shopify Pay, as more people start using their subscription services, as more people start using this and that and this and that, could this go really, 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 really high up in terms of their revenue? Could I be really conservative about my margin? Could I be really conservative about my revenue assumptions? Yes. If you believe that, then that's certainly a valid belief to have. But for me, I just don't know enough right now to make that assumption. And to me, at this price point, it just doesn't seem all that attractive from a valuations perspective. Now, if we were to drop into the 60s, and if I wanted, for example, a 10% target return, a fair value of 63 would make sense. If I wanted a 15% target return, because I think this is a risky proposition, given it's a growth stock that's already shown that it can go up 50 and 70, it can go up 200%, but drop 75% any given year. A 15% return is a $50 price point. So You may think that's crazy, but this is a stock that was at 48 bucks 6 months ago. And has that much changed since then? A little bit. The picture is certainly rosier than it was 6 months ago, but it's not that much different. Oh, it just seems a bit rich right now. But I will put in a alert for myself in the mid to low 60s to revisit the stock again. So let me know what you think. Am I wrong here? Am I missing anything on Shopify? Are you a bull? Do you think $80 is a great buy-in point? Do you disagree with me completely? Do you agree with me? All of that stuff. I really am just here to learn, share my thoughts with you guys, to have an open dialogue with anybody who wants to comment. Leave a comment down below and let me know what you think. As always, if you enjoyed this video, like. If you are here for the first time and want to see more of this kind of stuff, I kind of tend to ramble, but apologies for that. As a reward, find Waldo in here. Give you one more second. Oh, okay, bye.